Hello, viewers. Welcome to part 5 of Accounting Fundamentals. Now, in the last session, we discussed about the profit and loss account, the income side of profit and loss account. So, in this session, today we will try and understand the components of expenses, which is the other side of your profit and loss account, right? So, let's just move on to the expenses part. So, what are expenses for a organization? We had seen this in our earlier business processes and business fundamentals, right? So, expenses are money spent or cost incurred in an organization's effort to generate revenue. It basically represents the cost of doing business, right? So important thing that we have to understand here is that these are the money the company spends apart from the major or primary purchases. Okay, so this is apart from your purchase cost, all the other expenses which the company needs to incur to generate revenue. Now again, like the way we saw, the income is broadly broken up into two types of income. Similarly, under expenses also, we will see two broad classification of expenses. So that is basically the direct expense and indirect expense. Okay. So let's try and understand what are direct expense, what constitutes direct expense. It is very, very important. In the previous session, I had mentioned about the gross profit and the net profit, right? So now, once we understand what constitutes direct expenses for an organization and what are the other expenses which can be classified under indirect expenses, right? So first, let us try and understand a very important and critical statement or criteria, which all of us have to remember. Okay, so direct expenses are those expenses connected with purchase of goods or manufacturing of finished goods. So in case of a trader, you are buying goods for trading purpose. In case of a manufacturer, you are buying raw material to convert them into finished goods. Okay, and those costs or those expenses apart from your purchase cost having an impact on margin or selling price of the product. Okay, so these expenses apart from your cost of your primary goods that you are purchasing, there are associated cost involved with your purchase activity or with your manufacturing activity, which needs to be considered as part of your costing. So that is what basically it says. These are the expenses which are having an impact on margin and selling price of the product. Generally, these expenses become essential part of trade or manufacturing. So which means these are the expenses that, it becomes kind of an essential or mandatory expenses in association with your purchase and production activities. So let me just quickly repeat this statement. Expenses connected with purchase of goods or manufacturing of finished goods having an impact on your margin or selling price of the product. So these expenses are generally essential part of your trading or manufacturing, right? So let's first try and understand the examples of the direct expenses. Then I will explain to you, give you a certain example, so that we are more clearer in distinguishing the expenses between direct and indirect, because all direct expenses which are included in your profit and loss account will impact your gross profit. All right, so let's try and understand with the example. So examples of direct expenses, yes, one is definitely your purchase cost, which is going to be your major value that is going to be involved, right? So purchase, generally, see, in case of a trading or in case of a manufacturing, you call out purchase uh, account separately, you call out sales account separately, so that at any given point in time, on the face of your on the face of your P&L account, you are able to see the value of purchase and value of sale, because that's the one information that you are going to constantly look into, right? So purchase is a part of direct expenses, but they are called out as a separate entity. Okay. Freight. So what is this freight? Okay. Now I'll give you an example. See, it is very important for us to understand. So the statement or the criteria says very clearly that this is going to impact your margin or your selling price, right? So let me give an example. Let us say that I am dealing in computer parts. Okay. So now I know that in Delhi, okay, so the computer parts are very cheaper, right? So when I'm buying at a bulk rate, I'm going to get a very good bargain rate, which is compared to any other place that I'm going to buy, it is going to be maybe 10-15% more that I need to pay. So what I do is that now I have found a supplier where I've negotiated with them. And now, uh, every time that I need the material, all I need to do is I just call him up and tell him, okay, bhaiya, dekho, you have to give me these items. You place an order over the phone, right? Now you have an arrangement with this supplier. What the supplier is going to do is that he is going to supply the material to you, okay, whatever is the rate. But the condition is that the supplier in Delhi has told you that, look, I will transport this material to your Bangalore showroom, but whatever is the cost of freight that that has to be incurred on this particular consignment, you have to pay. That means I am a buyer. My Delhi guy is a supplier. So the Delhi guy tells me that you have to bear the cost of freight. Okay. Let us say that, let me take one simple example. Let us say that I buy I have placed an order for say 10 numbers of wireless mouse and keyboard combo. Now each one of them is going to cost 1000 rupees, my cost, right? So 10 numbers I have ordered. So 10 numbers into 1000 rupees, 10,000 rupees is going to be my purchase value. Whatever is the applicable tax, he is going to charge the tax. Now, for him to transport that 10 numbers of keyboard to Bangalore to my place, he is now going to pay some freight charges, which we have already agreed that I, as a buyer, am going to bear it. Now, the freight charge for transporting those keyboards to my place will amount to, let us say, 1000 rupees. Okay. So which means 10,000 is going to be my purchase cost, and 1000 rupees is the cost of my freight, right? Now, if I am not considering this freight, okay, as my critical expenses, so the question now, so is this freight that I am paying, should it be my direct expense or should it be my indirect expense? Now, one thing all of you have to remember, see, whether it is a direct expense or whether it is an indirect expense, right? So it is going to impact your bottom line. But we will little later we will understand the implication of your direct expense and indirect expense. Okay, so that is where the statement of the criteria that says is it is going to impact your margin or your selling price. Now, I have purchased this keyboard at 1000 rupees. Now, I assume that, okay, my purchase cost is 1000 rupees. Can I now sell it at 1100 per piece, so that I am going to make a profit of 100 rupees, right? Now, if I assume that I am going to make a profit of 100 rupees out of this consignment, then literally I am making no profit, because there is another cost that is involved, which is my transportation cost of 100 rupees. Now, this is where it is important for you to see that what are those direct expenses which are associated with your purchase of your goods or manufacturing of the goods, which is going to impact your cost of sale. So, what is cost of sale? Cost of sale is the principal product cost plus all other associated cost, which gives you your cost of sale. Now, with the amount that you arrive as your cost of sale, you will consider your indirect expenses also, and then now you are going to set an MRP, or you are going to have a you will have a margin, or you will have your selling price. So in this case, until and unless the keyboards are not transported from Delhi to your showroom in Bangalore, you cannot sell these keyboards, right? So which means these are those expenses which are unavoidable expenses. So one very important criteria here with my statement, you have to understand these expenses are mandatory expenses or expenses which are unavoidable. So until and unless I don't get my keyboard to my place, then I cannot sell. Just having a purchase invoice, I cannot sell those keyboards, right? So these types of expenses which are associated with your purchase or manufacturing will be classified as your direct expenses, because you need to add up all these expenses and you need to arrive at your cost of sale. Okay, so let us take in case of a manufacturing. So now in case of a manufacturing, I purchase raw material, all right, and then I need a workforce, I need a person who can now, apart from that, I have my machinery, everything is there, infrastructure is there, but then I need a person who is now going to work on my raw material and convert those raw material into finished goods, right? Can I avoid that? I cannot avoid that, right? So if I don't have a person who is going to manufacture and then give me a finished product, so that I have a ready product which I can sell to my customer, then there is, I mean, like, my raw material is like going to lie as it is. And I can't say that, okay, I want to save money, I want to cut cost, so I will not have anybody to manufacture. You don't have your product. So these again are essential expenditure which is impacting your cost of sale. Okay, so, like this, right? So, anything which is influencing your cost of sale is what is a primary consideration that you need to have, and see that those kind of expenses are taken as part of your direct expenses. Now, why do we take that as part of your direct expenses? Basically, you have in my previous session, I had mentioned about your P&L account is broken into two types, right? So they have two parts to your P&L account. So one is basically called as trading account, and the other one is the profit and loss account. So in trading account, what constitutes trading account? Very simple. The moment we say trading, so it is, even if you're a manufacturer, after you manufacture, you need to trade that goods, your finished goods, right? So the trading account basically tells you what is that bare minimum profit that your company is earning, not considering your other expenses where you have to incur to generate revenue. So every expense is incurred to generate revenue, but again it calls for an important classification of these two types of expenses, right? So in the trading account, it is going to tell you in case if you are having opening stock of any inventory that you are holding, plus it is going to take your purchase. Like I said, purchase we call out separately, so that it's an important figure that I want to keep looking at it. If I put it under direct expenses, then I need to explode that information, or I need to go inside my direct expenditure to see what is my purchase cost. So that is why generally you bring purchase on top of it, and then just below that you have this direct expenses, right? Now, so this is your expenses part. Then on the right hand side, you have your sales, whatever is the revenue that you have generated, and you have a closing stock which 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 is arrived at the end of the period, whatever is. So what is the closing stock? The closing stock is the quantity and value of inventory the businesses are holding at the end of a given day. So normally, like I said, the whole context of our learning, we do this from a point of year end activity. So as on 31st of March of any financial year, right, you keep buying and then you keep selling, right? So whatever is the unsold stock that is lying with you, okay, so that is the value of the stock, which is going to say that, okay, see, you are not sold the stock, so it is going to put it on the credit side. Literally, if you see on the hindsight, if you notice, literally the closing stock that you put on the income side is like a notional sale. What do you mean by notional sale? So the notional sale that you arrive is that whatever inventory that I have purchased at my cost. Okay. Now, when we are going to talk about inventory fundamentals, we will be talking about the impact of your inventory that you are holding. How do you, arrive at the valuation of your closing stock? All those things we will go into detail. So here, the closing stock that I'm going to put on the income side is basically to, you know, put them as my notional sale. Supposing if I were to sell this at cost, what is the cost that is there? Okay. So now it is taken on the income side. Now, if you remember in my previous session, I had asked all of you a question that the closing stock that you are arriving at the end of the financial year, is that closing stock part of your trial balance? Okay. So I will give you the answer now. Let us see how many of you have guessed it right. Okay. So the closing stock is not part of your trial balance. So when I say trial balance, I had explained in my previous session in detail about how you draw a trial balance and what is the relevance and the importance of trial balance. Now, the closing stock figure is a balancing figure, right? So very interesting and very important area that now you're going to understand. So what am I going to do in my P&L account? Whatever is my unsold stock, let us say that my closing stock is say 5 lakh rupees. Now this value that you're going to do, we will see what are the different method of valuation that you're going to adopt. Any valuation method that you're going to adopt, it has to be at cost, right? You will not add any margin. Just above your closing stock, you have your sales. Now the sales has got your margin included in that, because you have actually transferred the right to use or the property to right to use to your customer. But these are the stock which you're holding in your organization, so you will value your closing stock at cost. Now there are different method of valuing your closing stock because of various complexity. We will discuss that later. So what I'm doing, I am now, see, our accounting system, we said, is a double entry system of accounting, right? So that means every transaction, any transaction that you're going to pass in your company should have an impact on the credit side and also should have an impact on the debit side. So the closing stock, which is a balancing figure that you arrive at the end of the financial year, you now put it on the credit side, right? So again, when we go into accounting fundamentals, I'm also going to discuss about, okay, so what is debit, what is credit, what type of balance asset is going to carry, what type of balance liability is going to carry, what type of balance income is going to carry, what type of balance expenses are going to carry. So for the time being, just 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 remember this: my income is a credit balance. Now I will explain this in my upcoming session. My income should have a credit balance by default. Okay. Similarly, my asset should have a debit balance. Okay. My financial statement, I said these are the two parts, right? So your balance sheet and your P&L account. The final balancing figure of your P&L account, which is your profit or loss, is carried over to your balance sheet. Fine. So what you are doing is that, the closing stock that you are arriving and you are putting it on the income side of your trading account, that's a credit figure. So you have credited 5 lakh rupees as closing stock, which comes on the credit side of it, right? Now, the debit aspect of it, because you have not sold that stock, because you are still holding it, because you have not sold that stock, you are now transferring that to your balance sheet as your asset under current asset. So under current asset, you have a group called inventory or closing stock. So the 5 lakh rupees you have credited in the P&L account, and the 5 lakh rupees, because it's not an income, right? So, and the same 5 lakh rupees you are going to now bring and put it here as your asset which belongs to you. So a credit entry, a debit entry is matching. So this is how the closing stock is arrived, and closing stock will never form part of your trial balance. Okay, so I think I'm clear about this. So we will also get into further detail of understanding in the upcoming sessions. So now, so the trading account is going to have these parts. So if you see here, these are mandatory thing. One is your primary purchase and your total sale, and also any direct income we saw in the previous session, or the discount received, rebate, and so many other things which are in relation to your major activity of your business. We have seen that, so that also will get added. So you will have your sales, then you have your direct income. So now all your income, sales plus direct income plus closing stock, minus your opening stock, minus your purchase. Okay, if your credit side, that is if your income is more and the expenses, in this case purchase and direct expenses, if that is less. So let us take an example. So my credit side of my trading account is 10 lakh rupees. Okay, 5 lakh is my closing stock, and 5 lakh is the sale that I have done, and there is no direct income so far. So 10 lakh is the credit total. Now my expenditure will carry a debit balance. So if one side is credit, the other side has to be debit. So now my expenses, which what are my expenses? My purchase cost plus my direct expenses. Okay, and my opening stock. So if that comes to say around 7 lakh. Okay, so the whole thing by opening plus purchase plus my other expenses, which are mandatory expenses or unavoidable expenses, you can call. Okay, so now that is 7 lakhs. So now my credit side is more, 10 lakh. My debit side is lesser, 7 lakh. So the excess of 3 lakhs is credit. A credit is nothing but your profit, right? So now this is what we call this as a gross profit. Now you take that gross profit, and now with that gross profit is what you are going to incur various other indirect expenses, which we will try and understand what is the characteristic of indirect expenses and what is the most important distinguishing factor between your indirect expenses and direct expenses, right? So I'm sure that you are clear about what constitutes direct expenses. Now, again, if you see, this is not a mandatory thing, right? It is important for you to know that as an organization, as an industry, as a business, right, you are supposed to definitely have a gross profit. You might end up with a loss. That is basically because of your other indirect expenses. We will just now try and understand the indirect expenses part of it. But if you are into a gross loss, then there is no point in running your business, right? So that is where the impact of your direct expenses are going to come. Again, quickly, for you to quickly remember what are direct expenses, all those expenses which are mandatory. My example, the 1,000 rupees that I have paid to get my keyboard from Delhi is a mandatory expense. I cannot say no, I will not. He is not going to anyhow bear the cost, right? So, or he'll say, okay, I will charge you 1,100 rupees, then that is going to be your cost of purchase. Whichever way, that 100 is extra thing that's going to happen. So any expenditure that I'm spending to make my product ready to sale, you can apply this other criteria. All those expenses which are incurred by the business or the organization to make the product ready to be available for the customer, or to make the product ready to sell. So in case of my keyboard, the moment the material comes to my showroom where I'm paying 1,000 rupees as courier charge, then it is ready to sell. In case of my manufacturing, I have to manufacture this raw material and get my intended finished goods, and all those expenses again are mandatory expenses. Until and unless the product is not manufactured or packed and kept ready, it is not ready for sale, right? So one very important criteria you apply is that any expenditure which is influencing your product to be ready for sale is another way that you can look into it. Let us now just come back to indirect expenses and see what are those indirect expenses. Okay, so indirect expenses are those expenses that are incurred to operate a business. Now, these expenses can be very important. Okay, these expenses can be controlled or evaded or eliminated. Okay, and remember, this also has an overall impact on your profitability, right? So now I have a gross profit of 3 lakh rupees, right? That's my bare minimum where I have now arrived at my selling price, my margin, and all those things. Considering that my on an average, this is what is going to be my indirect expenses. Now you got 3 lakh rupees as your gross profit. Now it is in your hand to how much of that money you can blow it out, or how much of that money that you can retain with you by prudently taking care of your indirect expenses, right? Again, I'll give you one example in case of indirect expenses. Let us say I am dealing in computer spare parts, right? And because I need to have a showroom where it is a business district, or where it is a where generally you have this computer market or something where people walk into those place and then they buy the product. So what I do now, I have a showroom where it's basically a business central business district, where people, lot of customers walk in for the purchases and all those things. And let us say that I pay a rent, monthly rent of say about 50,000 rupees. Okay, every month I pay 50,000 rupees a rental for that particular showroom. Now with the let us take this COVID pandemic example. Now with this COVID pandemic example, we have seen that in the last 8 9 months, right? So literally, I mean, like, in-person business is completely gone. Slowly now it is picking up. The last couple of months it is picking up, but otherwise, you see, I mean, like, many of the businesses started at least surviving by adopting technology or digitizing their operations or their business. Now, because of this, let us assume that now I switched my business to online, because online is the major commerce that was happening during this pandemic. And also with the introduction of online sale, even prior to COVID, we know that the online sale is much better, and year on year, the online sales is growing. So now this is one important activity that I need to do because of, let's say, COVID. So now I moved on online portal. So I started selling through Amazon, through Flipkart, and various other portals, right? So now, what in this 7 8 months, my 90% of my sale is happening on online portal, right? So now in the last 2 months, when when it got relaxed, when those all those shutdown, everything got relaxed, I opened my showroom also. But then hardly now I have 5% or 10% of my prospect or my customer walk into my showroom. So 90% of my business happens there, right? Now the question, now the rent that I'm paying is basically a indirect expenses, because this is my effort to generate revenue. I need to spend money. So these are the expenses that are incurred to operate my business, right? So now, because 90% of my business is happening through online portal, why do I need a showroom by paying 50,000 rupees in this central business district? I don't need. So, which means literally, if you see, I can now completely avoid that expenditure of 50,000 rupees per month, which is going to help me to improve my bottom line. Okay. So, I can evade it, right? Now, I'll give another example. Let us say I started this business newly, and I purchased Tally. Now I'm looking for an accountant. So nowadays, I mean, like, the minimum salary for an accountant, whoever claims that I'm an accountant and then getting into the accounting field, the minimum today you have to pay is 15,000 rupees is the starting salary that you need to pay for a accountant, right? So 15 is 1,80,000 rupees per month that I have to spend. Now this again, these are my expenses I need to incur to manage my business, right? So any salary that I'm going to pay to an accountant, if I'm appointing an accountant, then it is going to be 1,80,000 per annum I'm going to do. Now my friend walks in and then he says, "Hey, bhaiya, why do you want to have an accountant? You are a very small company, you have very few transaction, right?" So there is a friend of mine who's a tax consultant, right? So that person is a freelancer, right? So I mean, like, weekly once, I know you have a system, you have tally in it. So weekly once or twice this person will come to your place, whatever your purchase, whatever your sales, whatever your expenses are there, let he will just capture that in tally, and he will also take care of your filing of your GST return, right? So all you need to do is pay him some 5,000 rupees per month, right? So now I need an accountant because no, I don't have time to sit and take care of my accounting. Now if I had time, then I could have 100% eliminated that. Now my core strength is running the business. No, I can't you know allocate any additional time from my business to any of this activity. So which means I cannot avoid my accounting activity, but I can control my expenses. So if I had appointed an accountant, I'll end up spending 1.8 lakh per annum. Now if I account, see, my objective, my work is getting done, right? Now if I appoint this particular tax consultant, I'm going to shell down only 60,000 rupees per annum, which means one third, right? So now I'm saving this. So like this, if you see any indirect expenses, you have better control over the indirect expenses, because remember, you have a gross profit of 3 lakh rupees. So your resources should be within that, so that you reduce whatever expenditure is there, and the remaining is what in your hand, that how much of NP that you're going to get. Certain cases, like I said, there will be some expenses we cannot avoid, but I'm not talking about all the expenses. I give two use case scenarios where we have seen that I can eliminate one particular expenditure, or it all depends on your business conditions and various other factors, right? So I have reduced my bookkeeping cost by one third. But you see, in case of a direct expenses, right? So I made a statement that in case of a direct expenses, you will have very little control over that expenses. You can never avoid those expenses. Any expenses which cannot be avoided, right, and you have a lesser control, also forms part of your direct expenses. Now let us take the same uh, my courier charge of my keyboard, wireless keyboard and mouse, right? So my person is going to send from Delhi to Bangalore. Now, so 1,000 rupees is the courier charge, right? So which means literally it comes 100 rupees per number, per keyboard. Now this person, he sends it through, let us say, what is that, Blue Dart Courier. Let us say he sends it through Blue Dart Courier, and all of us know that Blue Dart Courier is a standard, more reliable, yes, and it is quite expensive compared to other local courier guys, right? So in any case, I have to pay 100 rupees for keyboard. Right? I cannot stop that. I cannot eliminate that. If I eliminate that, my keyboard is going to lie with my supplier. So I don't have sales to make, right? But I can have little control over it. What is the kind of control that I can have? Now I speak to some guy here who's a professional courier or some other person close to my showroom. So I negotiate with them, and then we fix up saying that that person says, "Don't worry, sir. You ask your supplier to book through my professional courier, and I will charge you only 75 rupees." Okay. So what is the best thing that you were able to do? You were able to reduce 25 rupees per each thing. But in any case, you cannot eliminate, you cannot avoid. Now, this is what I was talking about, the direct expenses. All the direct expenses will have an impact on your selling price or your cost of sale, and also those expenses which are incurred for you to have your product ready to be available for sale. Okay. Now, it is very easy for us to understand the examples of indirect expenses, right? So, office rent, okay, the factory rent that you are paying ideally should form part of your direct expenses. Again, it depends, right? Like I said, I mean, it depends on business and what is that it's your business. You decide. Ultimately, you are going to get net profit. But important thing is that if you are if you are not considering all those things, you will show a larger gross profit, right? When somebody is considering all those things, we'll have a standard gross profit. So somewhere it is going to impact, but overall your NP is not. It all depends on how you manage your overall expenses, right? So what was I telling? Huh, right? Huh. I was talking about the rent of the factory. The factory rent is ideally direct expenses, because because if you don't pay rent, then you don't have a factory to run, right? So that is also going to impact your cost of sale, right? So you will do this. And when we come to inventory fundamentals, we will also discuss about what are the other associated product related expenses which should also form part of your direct cost. We will come to that. Okay. So office rent, wages that you pay to your employee in the factory, we just discussed that that is a direct cost. The salaries that you are paying to your employee for operating your business is your indirect expenses. So conveyance, printing and stationery, all your telephone expenses, conveyance costs, repairs, travel, and so many other things are there, right? So these are your indirect expenses. So just to to sum up, what is our understanding of direct expenditure, indirect expenditure, right? So now we are very clear that all those expenses which are required, which are impacting your cost of sale, will be considered or has to be considered as your direct expenses. And all other expenditure which are purely an administrative or operating expenses for you to effectively sell and manage your operations, those are your indirect expenses, right? So direct expenses is going to impact your gross profit. I've also told that the moment you get your gross profit, rest is left with you. Out of the 3 lakh rupees, that gross profit that you have earned, how much can you additionally save? And that becomes your bottom line, and that becomes your NP percentage, right? And indirect expenses, we have seen that all those expenses where I as a business decision maker have a better control over it. Certain indirect expenses can be avoided, certain indirect expenses can be reduced drastically, right? So so this brings us to the end of our session on profit and loss account. So we have also seen the different types of expenses and our income, broadly two broad classification. And here we have seen two broad classification, and this is an important area. So we understood the differentiation between the direct expenses and the indirect expenses, their impact and implication in your profitability, right? So thank you once again, all of you, for staying till the end. So as usual, if you have not subscribed, kindly subscribe. If you like it, kindly press the like button, or you can share this so that your friends and colleagues can benefit out of this. So thank you all once again. See you till the next session. Thank you.